I completed last year review of equity markets for Vince Cable and his Department of Business, Innovation and Skills. And I think it's quite important to say that I was asked to do it by the Department of Business, because that set from the beginning what the perspective which we adopted was, which was to say that equity markets are there for the users of equity markets. And by users of equity markets, I mean the companies whose shares are traded in equity markets and the savers whose funds are invested in them. It seems perhaps, it certainly ought to be, banal and obvious that markets are there to serve the customers of markets. And yet, in looking at the financial services sector, one so often gets the sense that people believe, whether as policymakers or as participants, that the purpose of markets is to serve the needs and interests of market participants. But markets are for users, and the success or failure of equity markets is to be judged, and in my view only to be judged, by the criteria of what do these markets do for companies, what do they do for savers. Well, how do they do for companies and for savers? When we looked at how equity markets in the UK were performing, there were some things we learned quite at an early stage of our research and deliberations. One really quite important one was that as a source of finance for business, equity markets simply do not register on the radar screen. If you ask where business gets money to invest, it isn't from equity markets. In fact, if we go over the last 2 decades in Britain and strip out the rescue rights issues which were made by British banks, which were mainly subscribed to by the UK government, if we strip out these rescue rights issues, we find that equity issuance by UK companies was negative, not positive. By that I mean that the amounts that disappeared from the equity market through share buybacks and acquisitions for cash exceeded by some margin the amount that was raised in new equity. IPOs have been on a steady declining trend for a long time, a declining trend which, as far as UK-based businesses are concerned, has approached zero. There have been almost no issues by UK-based businesses of new listings in UK markets in the last 4 or 5 years. And when we talk to small and medium-sized companies on the one hand, we realize that it was very rarely the case that these companies now saw acquiring a listing as a natural stage in their successful development, something very different from where one would have been 20, 30 years ago. They didn't see a listing as part of their agenda. And equally, when we talk to large investment institutions, they described what they were doing as, in effect, a buyer's strike, that if one looks at the years since the turn of the century, one finds that the companies which acquired new listings in the early years would typically produce so many horror stories for these investment institutions that was in large part the reason for their decline of interest. Of course, these two things go together. The lack of interest in that route by good small and medium-sized companies, the lack of interest in acquiring through that market on the part of institutions. There are, of course, quite a number of IPOs still in London, but the majority of them are either of companies that have little or no connection with the UK, or they are of financial companies of one kind or another. What's also important as background to this is the way in which the structure of business has changed, with the result that the successful small and medium-sized company now becomes cash generative at a much earlier stage in its life than was true when the typical company was a manufacturing company which would need to come to market to raise funds for investment in plant and machinery. It was exemplified for me in the rather disarming statement in the Facebook prospectus, although that company unusually did raise a significant amount of new money at the time of its flotation, 16 billion, it said it had no idea what it was actually going to do with the cash. The reality is that when companies do list, and they don't now list very often, they do so more to provide value to the employees' share options and a liquidity event for early stage investors than to raise funds for investment. Paradoxically, public equity markets have ceased to be a means of putting money into companies. They've actually become a way of getting money out. The second thing we learned was how the structure of shareholding in quoted companies in the UK has changed. If we'd been talking 50 years ago, the main holders of equity in UK companies were UK resident individuals. 20 or 30 years ago, it would have been true, it was certainly true in the early 90s, that the dominant holders of UK equities were UK-based pension funds and life insurance companies. That isn't true anymore either, and the share of these institutions has fallen from over 40% to under 20%. It's fallen as a result of regulatory and other changes that have meant equities are a smaller part of the total portfolio of these institutions. It's a result of globalization, which means both that UK institutions hold more overseas equities and correspondingly that overseas institutions hold more UK holdings. And it's also a product of the outsourcing of investment management functions by intermediaries. Today, if you ask who are the major players in British equity markets, the answer would be it is large asset management firms. Some of them, the European or UK operations of big American firms, BlackRock's, Fidelity's, Vanguard, some of them the UK-based firms such as M&G and Legal & General, and the largest 6 to 10 of these asset managers now speak for getting on for half of UK listed equities. Third thing we discovered was that the chain of intermediation between the two market users whom I described, companies at one end and savers at the other, is now ridiculously long. If I just list the number of people who have interposed themselves between the two groups of users of the markets, I can list registrars, nominees, custodians, fund managers, fund-of-fund managers, investment consultants, pension fund trustees, insurance companies, providers of wraps, platforms, independent financial advisors, the list goes on. And there are two consequences of the length of that list. One is the cost, that a very large part of the underlying return being earned for savers is being taken out by the costs of intermediation. And the second is that every one of these intermediaries has their own business model with their own business imperatives, which are not necessarily well aligned with the underlying interests of the users of markets, the savers at one end of the chain, and the companies in whose funds they're being invested on the other. That's an analysis of where we of some of the basic things we discovered about the functioning of equity markets. We talk a good deal in the report about the question which the Secretary of State gave to me, the question of the extent to which that inhibited good long-term decision-making by UK companies. I don't want to say an enormous amount this morning because I'm going to focus primarily on issues to do with the structure and functioning of equity markets themselves. But I want simply to say that there were three kind of groups of heading under which we saw cause for concern there. One was what had happened to physical investment in UK business. I've talked a little about that already. That was perhaps the least concerning of my three headings. The second heading was, as it were, investment in intangible assets by UK companies. And I think we found a good deal of cause for concern of the way in which the pursuit of short-term earnings targets by UK-listed companies had actually undermined the long-term competitive position of these UK businesses. The financial sector is an extreme example in which many institutions have essentially destroyed their reputation with consumers in the pursuit, which in most cases turned out not even to be very successful in the long run, of short-term returns for their shareholders. But I can tell the same story across whole areas of British business. Every one of you will be conscious of the bewildering tariffs which you face, for example, when you buy telecom services or other utilities and the like, or the way in which in that sector, as in the financial sector, the profitability of the retail side of the business depends in large part on people paying amounts in charges which they never intended to pay or expected to pay when they signed up for particular contracts in the first place. That's a strategy which does generate short-term income. It's not a strategy which generates a strong competitive position for businesses in the long run. We were also concerned by the ways in which corporate executives in listed companies frequently seem to see their job as being that of managing a portfolio of businesses in rather the same way as an asset manager manages a portfolio of shares. The extent to which either financial engineering or merger and acquisition activity had come to gain a priority over actually improving the operating performance of the underlying businesses. And perhaps the most telling indication of that was to look back 20 years and remind oneself, for the Department of Business, what were then the largest industrial companies in the UK, and the answer to that question would have been ICI in the chemical sector and GEC in the electrical engineering sector. Where, one might ask, are these companies now? The answer is that both of them were destroyed, essentially, by the kind of portfolio management of a set of businesses which I've described. And it turned out that, firstly, that the managers involved were not actually very good at that kind of portfolio management, and secondly, that very large amounts disappeared in the costs of this particular activity. So, in our view, there are plenty of reasons for being concerned about the way in which public equity markets today impinge on the performance of business. If we have these concerns about the way in which markets are operating, what are the underlying causes? I think if one looks at what has happened in financial markets over the last 2 or 3 decades, the overwhelming theme of that evolution has been one of the substitution of transactions and trading for relationship-based activity. And there are many manifestations of that and many aspects of that, but that is true in equity markets, and it is true equally in other financial markets, that it used to be the case that mortgages were given in a process in which you went to the branch of a building society, where a not particularly sophisticated building society manager would assess your creditworthiness in a face-to-face interview, and you would then receive or not receive a mortgage which would be held on the building society's books, potentially for 20 or 25 years to maturity. We largely replaced that by a system of mechanized credit scoring of loans, which were then securitized and packaged and resold in wholesale financial markets. And I think what we have learned is that the job was not done better by that more complex process. It was actually done quite substantially worse. The systematic replacement of transactions and of relationships across the financial sector by transactions and trading has been the dominant development in financial markets, equity markets and other markets over 2 or 3 decades, and it has not in the main led to an overall improvement in the quality of intermediation, in the sense of improvement in the quality of the information and monitoring of underlying activities, which is the fundamental purpose of financial intermediation. What we need to do is to look towards a world which doesn't exactly replicate the kind of relationships that existed 3 or 4 decades ago, but as more of the character of commitment and information and understanding which that kind of environment produced. The second issue on which we focused is the role that incentives play in all of this. When I use the word incentives, you probably think I'm going to talk about bonuses and charges, and I might talk about bonuses and charges, but that's not the issue on which I want to concentrate. The issue on which I want to concentrate, rather, is to say that in the financial sector as elsewhere, people tend to behave in the ways in which you would expect them to behave in the environment in which they find themselves. Now, that's actually immensely relevant to the way in which we regulate the financial services sector. Because effectively what we did when we embarked on a process of regulatory reform in the 1980s was to replace a regime that was very largely focused on values and on industry structure by one that was based on relatively detailed controls of the behavior of players in the financial services industry. That is, we removed the barriers to the structural barriers that existed between different kinds of institutions, allowed the creation of large financial conglomerates, and perhaps inevitably, as the city changed and became more international, we moved from an essentially values-based system of regulation to one that was substantially rule-based. The result is one which I think we all recognize today, which is that we have a system of regulation which simultaneously succeeds in being very extensive and intrusive, and on the other hand operates very poorly at serving the interests of the objectives of meeting the interests of the underlying users of markets, whom I've described as the companies in whom funds are being invested, and the savers whose funds are being placed there. Moreover, we are following a route which is very familiar to people who have studied the history of either regulation or central planning, and they have substantial elements of similarity, in which rather complex structures of monitoring and incentives do not actually have exactly the desired effect, with the result that we create a still more complex set of rules in order to remedy the problems which have emerged in the course of the earlier set, only to discover that that is a process which we have to repeat again and again and again. And that is how we have found ourselves in a situation where we have rule books so complex that they can only, in fact, be understood by professional compliance staff, and in which we've developed a regulation industry of compliance professionals, regulators, and the lawyers and consultants who mediate between the two, an industry which is as self-referential, spends as much time talking to itself as much of the rest of the financial services industry does, and which today has a vested interest in its own expansion. You can see some of the reasons why the article that Ross described at the beginning put a headline of saying Dr. Doom, because I don't feel happy about the situation I'm describing, nor do I believe we are moving very much in the right direction. I don't feel happy about where we are today because I believe that, because as I have described, we have lived in a world in which equity markets are not working well for the companies that might but don't raise funds in these markets. And equity markets have not been working well for savers either, who have enjoyed pretty disappointing returns over the last decade, even if the pattern doesn't look quite so dismal today as it does when we reported a year ago. It's still true that the decade since the turn of the century has been one of relatively poor returns for savers in equity markets. And if I describe a situation in which companies are not making much use of these markets, in which savers are earning rather poor returns to them, and in which market participants have never enjoyed a more prosperous decade, I think I'm describing a world that is simply not sustainable in either political or economic terms. And I don't believe it is sustainable in either political or economic terms. Let me look forward then to a world that might be rather different from the one in which we enjoy today. Because I'm quite clear that we need a vibrant, active financial intermediary sector. It's just at the moment we have too much intermediation, and it is not doing well, in general, the jobs which we want it to do. I would like to see a situation, firstly, in which there were many fewer links in the intermediary chain, in which typically there were one or two intermediaries filling that space between the saver at one end of the chain and the company in whom the funds are being invested at the other. I would like to see a world in which we build on the central role of the asset manager, but have an expectation that an asset manager will have a real understanding of the companies in which he invests, and typically a long-term commitment to that company in which he invests. And that means that that would be associated with longer-term mandates on the part of those who place funds with asset managers, whether they're retail investors or whether they are themselves intermediaries, in which these agents realized that it was not only perfectly okay, but actually in their own best interest to adopt strategies that searched for managers whose style of management they like, and be willing to say to these managers, go away for 3 or 5 years and come back at the end of that period and tell me how you've done. A very different world from one in which these people are advised by independent financial advisors or by investment consultants to place their funds with whoever has outperformed relative to his benchmark group over some relatively short historic period, a performance comparison which academic research shows has almost no informational content as far as the future performance of these managers is concerned. Is that simpler, less costly world of intermediation, in which fund managers typically have more concentrated, more focused portfolios, and one in which, as a result of that, they are better informed about the companies in which they invest, able to take a long-term view of the companies, and in which the companies concerned would feel more confidence when they need funds for development of their business in using equity markets as a means of obtaining the required money. It's for that reason that I'm actually rather happy to be asked to talk at this particular event, because the kind of vehicle which is represented in the room today is very much the kind of vehicle which I would see as being part of the future which I've described. It has 2 characteristics that I think are important towards developing the future which I've described. One of these is that it is effectively blurring the distinction between public equity markets and, as it were, private equity markets, a distinction which is currently being blurred in all kinds of ways, as the basic dysfunctionality of current public equity markets becomes more evident. Companies are less inclined to use them. Savers are actually more jaundiced about them. It seems to me paradoxical that an active trading environment was more necessary when the dominant holders of equities were private individuals than it is today when the dominant holders of equities are large asset managers. And yet it's in the transition from the private individual as dominant holder to the large asset manager as dominant holder that the trading culture has actually grown greatly in scale and significance. We don't need the same degree of trading activity to make the intermediary sector work as we once did as far as public markets are concerned. So we're blurring a distinction between private and public equity markets, something which is evidently happening as one sees the steady growth in markets, secondary markets for private participations. It also seems to me that a key feature of the sector which we're here to talk about today is that it is the intermediary rather than the company and the private equity market, which is providing the rather modest amount of liquidity which the end user, which the saver actually wants from the equity market chain. That is, many of the problems which we've evidenced in long-term decision-making in companies comes from the way in which the obligation to give liquidity to savers, to divorce the time horizons from savers from the time horizons of equity creates or requires an active market in the underlying company's shares. But part of a future in which the dominant players in the equity investment chain are in fact asset managers is that it is the asset manager who is providing, in effect, the liquidity which savers want, rather than the company and the company and trading in the company that is the source of that liquidity. And that, of course, is precisely the model which is developed in the listed private equity sector. So I think the kind of vehicles we're talking about today, I very much hope that this will be an increasingly significant part of the investment scene. And it's a way of developing, in the right kind of measure, the role of private equity, I think, because we learned that private equity at its best can be very, very good. It's a means of providing long-term committed funds for companies in ways that enable management to develop the operating capabilities of businesses in ways that I've noted were inhibited or were often inhibited by the demands of public equity markets. But it can, of course, be very, very bad, and has been in many of its manifestations over the last decade, in which essentially short-term, highly geared investment in companies were used to jack up earnings per share over a short period so that the return, so that the company concerned could in effect be flipped back to a private secondary market or back into a public market at a rating which was intended to make money relatively quickly for particularly the carried interests of the private equity managers concerned. If that's the good news, which I want to bring to the people in this room today, it is to say, the bad news is to say that the fee structure of the private equity business as it has emerged is not one which I can see the environment which I've described as being either able or willing to support. But that's something which no doubt people will wish to pursue in discussion. Let me then say that I think what you in this room are doing, both those of you who provide these funds and those of you who invest in them, are a large part of what I hope the future of equity markets will be. I don't think it's too much of an exaggeration to say that the era of public equity markets as we have known them is, if not at an end, at any rate one that is now in long-term decline. I don't think the developments which I've described are purely cyclical, because I don't think the causes which I've identified for them are purely cyclical. What is a phenomenon of the recent decade has been the one I've described, in which companies don't make much use of these markets, in which the effects of the public equity markets on corporate behavior is often negative, and in which savers have enjoyed rather disappointing returns. When I look at Britain in international context, you will recall that I mentioned Britain's two leading industrial companies of 20 years ago, both now effectively defunct, as ICI and GEC, a chemical company, an electrical engineering company. If I ask who are the leading electrical and engineering companies in the world today, the answer is Siemens in the electrical engineering sector and BASF in the chemical sector. And it may not have escaped your attention that both of these are German companies. The notion that the Anglo-Saxon model of hyperactive public equity markets was and is an inevitable future to which benighted Europeans were eventually bound to converge is, I think, a very seriously mistaken view of the relationship between markets and business. And I don't think we can simply transplant models from elsewhere or would want to. But I think we need to learn to take a more sophisticated, nuanced view of the way in which markets work, one that certainly doesn't regard liquidity, price discovery, and transparency as self-evident mantras for the efficient functioning of markets. And above all, I'd like to see a world in which everyone understood that the purposes of financial markets are to serve the needs of business and the needs of savers. Thank you all.
Well, thank you very much for that, John. The Professor is about to join a panel looking specifically at active fund management as well as some of the issues he's been through. We've probably got time for one question, though, before he does join that panel. If you have a question that perhaps isn't on active fund management, but about something else that he's covered. There's a question there in the middle, chap with his, gentleman with his hand up.
Muha, Atlantic Omnium again. My question to you is not to do with this, but to do with what you've described being a symptom of an educational system. Germany has a wonderful apprenticeship system. You've described the two, Siemens and BASF. Is what you've described a symptom, not a cause, and the cause being we don't have the apprenticeship system that Germany has, or something else to do with the educational system going into companies and businesses? Thank you.
I think in reality all these things are very much bound up together. That is, if one looks at the vocational educational system, it's one in which historically in Britain, large private businesses and what was then the nationalized industry sector played a very large role in promoting vocational education in telecoms engineering, gas, electrical engineering, chemicals, and the like. So that the disappearance in Britain of the ICIs and the GECs, the break-up and the fragmentation of our utility sector, which had many positive aspects, as a matter of fact, but one of the negative aspects of it has been the decline of that vocational educational role which the historically owned nationalized industries pays. I think you're correct in identifying an important part of the issue, but it's all, to my mind, bound up together. And I wouldn't necessarily say that financial issues caused it, but financial issues have certainly been associated with the way in which vocational education in the UK has changed over the last several decades.